dear students, to the massive open online course on money and financial markets. Now, in today's module, we are going to talk about the international stock markets. And we are going to divide this international stock market topic into two modules, 1 and 2. So today is our first module, International Stock Markets 1. The main objective of this module is to understand how to design a strategy to source equity globally. And in doing so, we would try to analyze the motivations and goals of a firm issuing new equity shares on foreign equity markets, and to recognize the many barriers to penetrate effectively the foreign equity markets through cross-listing and also how to sell the equity abroad. Now, we all know that both individual and institutional investors, they invest in stocks of companies within their country and outside their country. And whenever they invest outside their country, it is done to reduce risk through diversification. So increasingly, investors have been able to invest in international stocks more conveniently than financial instruments called the American Deposit Receipts, or the ADRs, and the Global Deposit Receipts, that's the GDR, that are listed on markets in their own countries. So before we try to elucidate how equity is outsourced globally, we try to understand what are these depository receipts. Now, depository receipts are something that are negotiable certificates which are issued by a bank to represent the underlying share of stock which are held in trust at a foreign custodian bank. Now, when I look at depository receipts, we generally refer to two very important terminologies. One is the GDR, or the Global Depository Receipts, which refers to certificates which are traded outside the United States. While we have the American Depository Receipts, or the ADRs, which are certificates that are traded in the US. Now, ADRs are sold, registered, and transferred in the US in the same manner as any share of stock, with each ADR representing some multiple of the underlying foreign share, which is called, basically the ADR ratio. Now, when I talk about ADR is a dollar-denominated negotiable certificate that represents ownership of shares in a non-US company. The structure of an ADR includes a ratio which correlates the amount of underlying shares to the receipt. And the ratio is generally the number of underlying shares represented by one American Depository Receipt, that is the ADR. That is, ADR is to shares. The ratio is typically depicted as, for example, 1:3, where one ADR is going to represent basically 3 underlying shares. Or suppose if the home share price is very high. For example, a 2:1 ratio would indicate 2 ADRs representing 1 underlying share. And this, you can also represent it as 1:0.5. That also exactly is going to give you the same meaning. Now, when we try to source for a strategy where we would like to source equity globally, we have certain observations. One is, most firms, they source equity locally within their own domestic markets. Why do they do so? Because most firms are generally unknown in the global markets. However, corporations have issued equities outside their home market to finance subsidiaries in other countries, or sometimes to reduce the cost of raising the equity capital. If we move into international bond markets, combined with cross-listing of outstanding equity shares, that also is sometimes done to gain recognition. Sometimes equities are tested in smaller markets, and eventually they are listed and offered in target equity markets like the London Stock Exchange or the New York Stock Exchange. What do we mean by a euro equity? What is a euro equity? It is a stock issue that is offered simultaneously in several countries by an international syndicate. In addition, we have US corporations engage in equity offerings where, in addition to the primary US component, they include a portion of the issuance reserved for sale in the euro markets. This portion of a newly issued stock is referred sometimes as euro equity tranche. Similarly, European firms, they also offer equity securities with the US tranche. So it goes on both ways. The innovation of the euro equity markets was not a matter of new equity securities or structures. Rather, the innovation consisted of an efficient international system for selling and distributing equity offerings to various markets in different countries at the same time. Thus, on both the investing and issuing sides, the international markets are critical to the world's equity market. So we need to have a clear idea about the various aspects of the international stock markets. Now we come to a very important concept. It is also known as the cross-listing or multiple listing of shares. Now, the listing of shares of stock on two or more exchanges are called cross-listing of shares or multiple listing of shares. They are generally cross-border in nature. Like, say, suppose you are listing a share simultaneously in, say, New York Stock Exchange and the London Stock Exchange, or in the New York Stock Exchange and in the Tokyo Stock Exchange. There are obviously fees involved in the process, and also there are certain amount of disclosure requirements that are to be involved. So when I talk about multiple listing or cross listing, so it is understood that stock of corporations can be listed for trading on stock exchanges in other countries as well as exchange in their own country. Now, there are stocks of very large companies which are listed on stock exchanges in several countries. Like the number of stocks of firms from other countries that were listed in the German National Stock Exchange, which we call the Deutsche Börse, as in the year ended 1999, was around 7,682. German domestic companies out of that numbered only around 933. So all the remaining around 6,600 of them were international stocks that were listed in the German stock exchange Deutsche Börse. Multiple listing of stocks is clearly an increasingly common phenomenon. 1.5 million securities of the German and international providers are traded on the German stock exchange in recent times. The exchange provides its investors with two trading platforms. One is called the Xetra and the other is called the Frankfurt Floor Trading. I'll be explaining all the various international stock exchanges that are there in the world in my next module. Multiple listing of stocks is clearly a very, very interesting and increasingly common phenomenon. The readiness of an exchange to list and trade the shares of a foreign company varies by country and also by the exchange according to their international orientation. Foreign firms that seek listing for their shares on the US exchanges may face some costs in terms of disclosure standards in some countries. In other countries, however, regulations on the listings and trading of the stock of a foreign company, they are not really very much stringent. So, suppose foreign firms that are wanting to come and list their shares in the Indian stock exchanges, like the Bombay Stock Exchange or the National Stock Exchange, they also face exactly the same situation. The most interesting thing that we go now is, what could be the possible reasons for multiple listing or cross listing? This means that by cross-listing and selling its share on a foreign stock exchange, a firm typically tries to accomplish one or more of the following objectives. Firstly, they try to improve the liquidity of the existing shares and support a liquid secondary market for its new equity shares in the foreign market. So basically, what are the firms trying to do? The firms are seeking to diversify their sources of capital across national boundaries and to tap all the various funds available globally for investment in these new issues. Secondly, they try to increase its share price by overcoming any sort of mispricing in a segmented and a very much illiquid home market. It also increases the firm's visibility and political acceptance to its customers, its suppliers, its creditors, and obviously the host government also. It establishes a secondary market for shares used for acquisitions in foreign country. And finally, it also creates a secondary market for shares that can be used to compensate the local management and employees in the foreign subsidiaries. In addition, we find firms may believe that an internationally varied ownership diminishes the prospect of takeover by other domestic concerns. And finally, firms may expect a foreign listing to boost their name awareness, and as a result, that is also going to boost the sale of their products. Now, to answer the question, can a share traded in different markets have different prices in those markets? The answer is clearly no. Because investors can buy or sell the shares in any of the markets, and they would arbitrage any meaningful difference that the shares may have in prices. What is arbitrage? Arbitrage basically means to exploit the presence of different prices for the same item in different markets. So if the price of a stock is lower in country A than in country B, investors would buy as many shares as they want in country A and then sell the shares in country B. So investors would do this until the pressure they were putting on prices in both the markets would drive the price together. So whenever we find that there is a decreasing gap in prices, it would mean that the arbitrage profits would basically decline. So investors would stop arbitraging when profits due to these price differences equals the cost of transactions. Therefore, whenever we find these various cost of transactions, including commissions, taxes, cost of exchanging currencies, whenever we try to fully acknowledge this, the rise of any share tends to be the same across different markets wherever it is traded. So you see, that what we're trying to say here is that whenever there is any differential in prices, we will find arbitraging taking place whenever we find that stock being traded in two different stock markets in two different countries. And at the same time, we need to acknowledge the fact that these various cost of transactions also tend to have created this price differential across these shares. So that means there is some sort of concept of trading cost or transaction cost in these international stock markets. And this cost vary considerably internationally, and they also affect the investment returns. The Broad Market Index, which was constructed by Salomon Smith Bartley, an equity index composed basically of 23 countries and has estimated that the one-way costs of trading market benchmark portfolios in those 23 countries in 2001. So there are various types of indices like this which are being constructed continuously to display this type of trading costs in the international stock markets. Now, we come to the basic concept now of global diversification, and this we try to relate it with correlation of the world equity markets. Now, there are various studies that have documented the potential portfolio diversification benefits of global investing. Inclusion of securities from other countries can increase a portfolio's expected return without increasing its risk or its variability in return. Similarly, if we include securities from other countries in a portfolio, they may reduce a portfolio's risk with no decrease in the expected return. Benefits of diversification, this augurs well because the international capital markets are less than perfectly correlated. This means their returns do not increase or decrease in unison. Together, that's together. So whenever I say that they are not perfectly correlated, so it essentially means that their returns do not increase or decrease at the same time together. So to be more lucid, correlation is a statistical measurement of the similarity in the movement of two variables. Say, let us take any two variables, say the rate of returns on groups of stocks from two different countries. So if I say that the stock markets, they are not very much highly correlated, that means they will move in ways which are different from one another. Now, here we come to various points. Different countries tend to have different policies with regard to taxation, with regard to monetary management, banking policies, political goals, economic stability, and so on. So it should be kept in mind that for many stocks, domestic events or local events will have the largest impact on the stock prices. And this really explains why prices of groups of stocks from different areas tend to move up or down at different times. They don't move at the same time. In fact, the degree of their movements are also not the same. They also differ. And this phenomenon gives the investors opportunity to diversify away a certain amount of risk in individual countries and create the benefits of international investing or global investing. That means basically it's the diversification of portfolio that really comes into play. So to answer this question as to what is correlation coefficient, because I have been talking about correlation. Now, correlation coefficient is a statistical measure, and it is used to measure both the degree and the direction of correlation between, say, any two stocks, any two variables. And the value can be anywhere between -1 and +1, though it is almost always in between. So any two securities which has a correlation coefficient of around 1, they are said to be perfectly correlated. This means that when one stock moves up 5 points, the other does exactly the same thing at the same time. So this has to be understood, what correlation means. And so if there is a correlation of -1, it is a perfectly negative correlation, meaning that when one stock goes up 5 points, the other obviously loses exactly 5 points. And this kind of behavior is incredibly rare in the stock markets. And so perfect correlations that I've just explained, this is almost entirely theoretical in nature. Now, we need to understand how and why these stocks correlate. Most stocks have a correlation somewhere in the middle of the range, say with a coefficient of 0. that's the middle of the range, which indicates that there is no relationship whatsoever between the securities. So say the stock of a software company, for example, may have little or no correlation with the stock of a chain of some auto parts store, because the businesses operate so very much different to each other. For example, the auto parts stock company must have a much higher dependence on the movement of physical goods, while the software company basically depends on digital transmission, or rather in terms of virtual transmission. But even such fundamental differences may not explain correlations or the lack of them. More often than not, stocks show correlation of price movement because how investors respond to them. For example, McDonald's and Caterpillar, they operate very different businesses, but their stocks are often very much highly correlated over time because both are components of the same major market index. Here, as you can see on my screen, I have got certain countries and I also have their correlation coefficient here. The countries that I have here are United States, France, United Kingdom, Japan, Germany, Switzerland, Canada, and Australia. Now here, as you can see in this correlation coefficient table, the highest is 0.71, and this highest value is between United States and Canada, okay? While we have the lowest value here of around 0.30, which is between Japan and Canada, which we also have between Japan and Australia, which we have between Germany and Australia, and so on. So we find that these international stock markets behave quite differently from one another. That is, the correlations of their returns are all substantially less than 1. Many values, as you can see in the slide, that many of their values are below 0.5. So investors can diversify their holdings by spreading their portfolio across these various markets. Geography and political alliances, they also influence the correlations. Like stock prices in Germany and Japan move less similarly. As I said, the stock prices there, the correlation equals 0.36. While Germany and France, the correlation is around 0.61. So here the stock prices do not move so much, they move more similarly. So consequently, investors seeking diversification, they should very carefully choose amongst the various markets. It is also interesting to note that all the correlations are positive and well above 0. So any absence of complete dissimilarity in the movement of stock prices represents. The positive value means that the world stock prices are somewhat integrated because all the values that I showed you are positive. So that means the world stock prices are somewhat integrated. So in other words, the benefits of diversification do have its own limits. And this means that the markets of the world are members of a somewhat loosely connected system of economies, and allocating funds amongst the various economies provides some but not complete reduction of variability in return on the securities. I'd like now to explain that there are certain factors that have tended to increase the correlation amongst the various countries' stock markets during the 1990s. That means, in other words, these factors have tended to reduce the advantages of diversification among the world's equity market. Firstly, one of the factors is behavioral, and the other is due to the structure of the economies and their stock markets. So the first point that I would like to emphasize here is behavioral. It relates to the behavior of investors during times of financial crisis, the times when investors would find diversification potentially the most beneficial activity. At such times, the reasoning goes that the investors become very risk averse, they would flee to safety and liquidity. So, if a crisis starts in one country for a legitimate fundamental reasons, investors will sell the stocks and perhaps bonds in not just that country or that region alone, but in all or in many of the other countries as well. These flight to quality will result in unusually high temporary demand for low-risk, highly liquid assets, and a simultaneous decrease in the demand for the price of all other risky assets. Such a crisis mentality increases the correlation among all or most risky assets and does so at a time when diversification is needed most. So here mainly the first point that I try to point out here is the behavior of the investors. So this panic behavior of the investors, whenever they see that there is some sort of crisis looming in the horizon in some economy of the world, and because of the integrated nature of the international stock markets, then investors in other countries also follow suit, and thus we find that they also try to sell off those shares of those companies, and there is the demand for shares which are less risky, more liquid in nature, starts to build up in the global scenario. The second factor that may increase international correlation relates to the structure of national economies and their stock markets. A country's economy can be postulated to be made up of two sectors. One is the global sector and the other is a country sector. The global sector provides goods and services that are provided in the global economy through international trade. Thus, the companies in a country's global sector respond more to global forces than to national forces according to this reasoning. Microchip manufacturing, automobile manufacturing, telecommunications, these are examples of global sectors. A microchip manufacturer in one country is affected by economic forces much more like a microchip manufacturer in other countries than like non-global companies in the same country. In contrast, the country sector produces goods and services mainly for the local economy. Companies in this sector are affected by economic forces more like other local economic companies in the same country than like the global companies in that country. Railroads, retailing, and construction, they are example of the country sectors. So the conclusion is that companies in global sectors tend to follow the global market for their goods and services rather than their local economy, and consequently they are not highly diversifying. For example, the stocks of telecommunication companies all over the world declined significantly during 2000. Companies in the country sector, in contrast, follow the indigenous economy and their stocks and therefore would not diversify in a global portfolio. So, we can say that when we talk about diversification, the stocks of those companies which are very much influenced by global trade or global factors will be influenced only by them, not by any sort of local events that take place in the economy. Next, lastly, we come to the concept of the benefits of international diversification. One of the most well-known results in finance is the decrease in portfolio risk that occurs with the sequential addition of stocks to a portfolio. Initially, the portfolio variance decreases rapidly as the number of the securities increases, but levels off when the number of securities becomes large. Statman, in its 1987 paper, How Many Stocks Make a Diversified Portfolio, in the Journal of Financial and Quantitative Analysis in 1987 issue, argues that most of the variance reduction is achieved when the number of stocks in a portfolio reaches 30. So if you go to any stockbroker and ask that what is the optimum number of stocks one should have in their portfolio, they will always give you the answer that 30 is the optimum number of stocks that you should have. Now, the intuition is that while individual security variance matters for portfolios with few stocks, portfolio variance is driven primarily by the average covariance when the number of securities become large. The lower the covariance between securities, the smaller the variance of a diversified portfolio becomes relative to the variance of the securities that make up the portfolio. So the primary motive for international diversification has been to take advantage of the low correlation between stocks in the different national markets. Solnick, in his 1976 paper in the Financial Analyst Journal, Why Not Diversify Internationally Rather Than Domestically, in that paper he writes, or he shows, that an internationally diversified portfolio has only half the risk of a diversified portfolio of US stocks. In his study, the variance of a diversified portfolio of US stocks approaches 27% of the variance of a typical security as compared to 11.7% for a globally diversified portfolio. So, if you try to reason out the two main factors that drive the benefits of international diversification, the first factor is average covariance or correlation between the markets, which I have explained in detail. And the second important factor is the number of markets that are available to the investors. Now, this factor is extremely important for the study of long-term benefits of international diversification, because the number of available markets has varied a great deal over the past few years. And the steady increase in the number of equity markets over the past century has provided additional diversification opportunities to the investors.